If a book can change the way you see the world, this is where you'll find it. I'm Karo Chen. Let's explore together the books that truly shape our destinies. Today we read Graham's The Intelligent Investor. Let's explore what it takes to be an intelligent investor. When you watch the stock charts flashing red and green, rumors spreading like wildfire, and everyone around you either cheering or panicking over daily ups and downs, have you ever clenched your fists torn between chasing the rally and fearing you'll miss out? That's when you should remember The Intelligent Investor, a book that has reshaped the financial destiny of countless people. Its author, Benjamin Graham, Warren Buffett's revered mentor, carved a path of reason through the chaos of Wall Street. He's known as the father of value investing. Over the past 80 years, the market has crashed and recovered again and again, while countless investment theories have come and gone like bubbles. But this book? It remains solid as gold, shining through every market cycle. Whether you're a newbie constantly getting burned or a veteran who loses sleep during market swings, once you open this book, you'll realize true investment wisdom isn't about predicting the market. It's about staying steady when everyone else is losing their balance. Have you ever experienced this? Your colleague's stock keeps rising for 3 weeks straight. Every lunch break, they're bragging about earning another month's salary. You can't resist. So on Friday before the market closes, you jump in. But come Monday, the stock plunges, and your account is down 10%. Or maybe you're holding a company with great financials, profits growing, cash flow strong, but the market suddenly crashes because of some industry rumor. You stare at the falling numbers on your screen, refreshing financial news at 3 a.m. And finally, at 5 a.m., you panic sell, only to find that a week later, the price quietly climbs back up. These buy high, sell low mistakes aren't new. Graham wrote about an even crazier example. In 1938, the Atlantic and Pacific Tea Company's stock fell to 36 Rs. Yet the company had $85 million in cash and $134 million in net assets. In other words, buying that stock meant you basically got all its factories, stores, and market presence for free. But because of short-term panic, investors pushed the price down to absurd levels. You might wonder, why do good companies get punished so badly? Why do so many smart people turn into nervous amateurs in the stock market? Back in 1949, in the very first edition of his book, Graham pointed out the key insight. If you keep doing what everyone else is doing, if you only chase the obvious, you will never make real money. But here's the question. Why can't we stop doing the obvious? Why do we all know the rule, buy low, sell high, yet always act the other way around? The answer lies in two deep psychological traps. First, we mistake speculation for investment. We think buying stocks equals making fast money, forgetting that real investing means buying businesses, not tickers. Second, we let the market's emotions control us. We treat price swings as if they reflect true value. It's like riding a roller coaster and screaming with the crowd, forgetting you're supposed to be traveling, not just shaking with the ride. Let's dig deeper into the traps that make investors stumble. Those same patterns Graham observed over 50 years of study. These aren't about luck, they're about psychology. He summarized them into 3 unavoidable layers of cognitive mistakes. First trap, treating speculation as investment. Many people don't actually know what they're doing when they buy a stock. Graham offered a sharp definition. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. So ask yourself, when you buy a stock, did you analyze its profits over the past 10 years, its cash position, or did you just hear a social media influencer say, "This one's going to the moon"? In 1962, the U.S. market saw an absurd phenomenon. Newly listed stocks being hyped to the sky. Take Aetna Maintenance, for example. It was issued at $9, shot up to $15, but its net asset value per share was only $120. Later, it crashed to 87 cents. Buying that kind of stock is pure gambling, no matter how fancy the story sounds. Second trap, being led by Mr. Market. Graham famously personified the market as an emotional partner who offers to buy or sell your shares every day. Some days he's wildly optimistic and quotes sky-high prices. Other days, he's depressed and quotes ridiculously low ones. The tragedy? Most people mistake his mood swings for reality. In 1938, the Atlantic and Pacific Company's stock was trading at $36, yet its liquid assets alone were worth $72 per share. When Mr. Market panics, he's handing you a gift. But most investors, driven by fear, sell along with him. Third trap, the human nature you can't escape. When markets boom, greed whispers, "Hold on, it'll rise more." When they crash, fear screams, "Sell now or lose everything." Back in 1929, everyone believed, this time it's different. Even shoeshine boys were giving stock tips. By 1932, in the depths of the bear market, no one dared to buy, even though many companies were trading below their cash value. Graham had lived through it all and said, the real challenge of investing isn't about math, it's about temperament. At this point, you might ask, if these traps are everywhere, how can anyone avoid them? Well, Graham didn't just describe the problem. He designed two practical strategies. He called them the defensive investor and the enterprising investor. If you're a defensive investor, your main goal is stability. Don't lose big and outpace inflation. So how do you do it? Step 1. Balance stocks and bonds. Keep half in high-grade bonds, like government or top corporate bonds, and half in blue-chip stocks, big established companies. When stocks rise too much and exceed 55% of your portfolio, sell a bit and rebalance. When they drop below 45%, buy more to restore balance. This method automatically forces you to sell high and buy low. Step 2. Only buy old friends, never hot trends. Choose large, leading companies that have paid dividends for over 20 years. Avoid stocks with a PE ratio above 20. Back in the 1960s, many growth stocks traded at 50x earnings and later crashed to a fraction of their highs, all because they lacked a margin of safety. Step 3. Do less, not more. Defensive investors shouldn't be glued to the screen. Pick your holdings, then check once a year. Adjust only when necessary. As Graham put it, the best time to buy stocks is when you have the money to do so, unless prices are much higher than sound valuation would justify. Now, if you're an enterprising investor, you're willing to do the homework. Your goal isn't just to protect capital, it's to earn above-average returns. But here's the thing. Higher returns always come with higher effort, not just higher risk. Graham offered 3 key principles to help you make that effort count. Rule number 1. Buy quality companies that have been temporarily overlooked. Within the Dow Jones Index, there are always a few companies that the market forgets, often because of short-term disappointments. Their PE ratios drop far below the industry average. In the 1950s, for example, U.S. steel companies traded at just 10x earnings, while others were at 15x. When the cycle turned, their profits recovered, and so did their stock prices. That's what Graham called a margin of safety. The market may be wrong for a while, but value always wins eventually. Rule number 2. Buy stocks below liquidation value. If a company's cash and inventory, after subtracting liabilities, are worth more than its entire market cap, you're essentially getting its factories in business for free. In 1957, Burton Company was trading at $20 a share, yet its cash alone equaled $56 per share. When the market noticed, the stock quickly rose by 20%. That's what happens when value catches up with price. Rule number 3. Avoid newly issued or hyped-up hot stocks. During the 1960s boom, new issues doubled overnight. Texas Instruments, for instance, skyrocketed from $5 to $250, paying no dividends, and later lost 80% of its value. Enterprising investors can buy growth stocks, but only when prices fall back to reasonable levels, below the industry average. When you look closely, you'll realize something. Both strategies, defensive and enterprising, share the same foundation. They both revolve around the margin of safety, the central idea that runs through every page of The Intelligent Investor. So, what exactly is this margin of safety? It's the buffer between what something is worth and what you pay for it. It's not about guessing market trends. It's about protecting yourself when you're wrong. Think of it as the foundation of a house. It needs to be strong enough to withstand earthquakes. When you buy a stock, your margin of safety might be a very low PE ratio, say under 10 for blue-chip stocks. Or it might be strong tangible assets worth more than the current market cap. When you buy bonds, it might be a company earning 5 times the interest it owes. Graham lived through the Great Depression of 1929. He saw countless investors go bankrupt because they left no margin for error. He once said, "Risk cannot be eliminated, but it can be managed by those who remain rational." In every market, two voices are always at war. One says, "Everyone's buying, don't miss out." The other asks, "Does this company really deserve this price?" Smart investors always listen to the second voice. When others become blinded by greed in a bull market, the intelligent investor quietly checks, can the company's earnings really support this price? When fear dominates a bear market, he asks, is this company's cash flow still healthy? Are its assets being undervalued? That's not just financial wisdom, it's life wisdom. It's about staying calm when emotions run high and focusing on the long game instead of short-term thrills. As Graham concluded, the investor's chief problem, and even his worst enemy, is likely to be himself. Reading The Intelligent Investor isn't just about learning to invest. It's about learning to think clearly, act rationally, and live patiently. So next time you make an investment decision, ask yourself, am I buying this because it's truly worth it, or just because everyone else is? Am I selling because the value has fallen, or simply because I'm scared? Once you can answer those questions honestly, you're already on the path to becoming a truly intelligent investor. Finally, congratulations on finishing another book.